Welcome back to Wealth Signal. I'm Alex Carter, and what I'm about to show you today is one of the most fascinating contradictions in modern investing. Two men, same company, same data, completely opposite conclusions about your money. Berkshire Hathaway is sitting on $397.4 billion in cash. Let that number sink in for a second. That is not just a lot of money. That is more cash than Berkshire has invested in the entire stock market right now. More than the entire annual economic output of South Africa. More than Apple, Amazon, Alphabet, and Microsoft combined hold in cash. And it's been building for 14 straight quarters. That's 3.5 years of Warren Buffett selling stocks and barely buying anything back. Now, the headlines are screaming that Buffett sees a crash coming. But here's the thing. He never actually said that. Not once. The real story is far more interesting than a simple doomsday prediction, and it has a twist that nobody saw coming. Because the very moment Buffett stepped back, his hand-picked successor did something remarkable. He started spending billions of dollars into the exact kind of market Buffett refused to touch. So, who's right? And more importantly, what does this mean for your portfolio? If you want to understand what the smartest money in the world is actually doing right now, hit subscribe and turn on notifications. We break this down every single day. Now let's get into it. The Cash Mountain. To understand what Buffett is doing, you need to understand what Berkshire Hathaway used to believe. For decades, their entire identity was built on one principle: find wonderful businesses, buy them, and hold them forever. Cash was the enemy, the embarrassing pile of money you hadn't found a use for yet. But as of March 31st, 2026, something historic happened for the first time ever. Berkshire's cash pile surpassed its entire stock portfolio. $397.4 billion sitting in cash and treasury bills versus $263 billion invested in stocks. The cash won. And because most of that cash is sitting in treasury bills yielding between 4 and 5%, Berkshire is earning somewhere between $15 and $20 billion a year in completely risk-free income by doing absolutely nothing. Think about that. The most famous investor alive has found a way to make $20 billion a year without touching a single stock. That is not a man who is panicking. That is a man who is patient. But here is where the paper trail gets really interesting. Every quarter, large investors have to file a document with the SEC called a 13F. Think of it as a public receipt of every stock they owned. When you line up Berkshire's receipts side by side across 14 consecutive quarters, the pattern is impossible to miss. Buffett sold roughly $195 billion more in stocks than he bought. That works out to around $3.7 billion of net selling every single week for 3.5 years. This wasn't a moment of doubt. This was a deliberate, sustained, years-long decision to get out. The selling trail. The clearest example is Apple. Back in late 2023, Berkshire held around 915 million shares, a position worth over $150 billion at its peak. It was essentially a one-stock portfolio. Then, the selling began. By mid-2024, Buffett cut the position roughly in half in a single quarter. By the end of 2025, he had slashed the stake by about 75%, down to just 228 million shares. Nearly 690 million shares sold. And the reasoning Buffett gave was pure valuation discipline. Apple's price-to-earnings ratio had ballooned from around 12 to 16 when he bought it, to roughly 33 by the time he started selling. In plain English, the stock got expensive, so he took the money. And it wasn't just Apple. Berkshire cut its Bank of America stake by roughly half starting mid-2024. Visa and MasterCard were dumped entirely. Around 77% of the Amazon stake was liquidated. The pattern is impossible to miss. The smartest money in the room was heading for the door. But here is what most people get completely wrong about all of this. Buffett never predicted a crash. Not once. If you actually read the transcript from Berkshire's annual meeting on May 2, 2026, the language is far more interesting than a doomsday forecast. What Buffett actually described was a shift in market psychology. He said he sees the market as, and I'm paraphrasing his framework here, a church with a casino attached. His concern is that the casino has become vastly more attractive than at any other time in the past. He pointed to people buying and selling one-day options and described it not as investing, not even as speculating, but as pure gambling. And notice what's missing from everything he said. No specific date, no percentage drop, no crash prediction. When the S&P 500 fell around 11% in early 2026, Buffett's response was almost dismissive. He looked at it and essentially said, "This is nothing." That is not a man bracing for impact. That is a man who simply doesn't think prices are interesting enough to bother. Now, there is one indicator that gives real context to where we are. Buffett himself once called it probably the best single measure of where valuations stand. It's called the Buffett Indicator, and right now, it's flashing numbers that are genuinely hard to ignore. The indicator is simple. You take the total value of the U.S. stock market and divide it by the size of the U.S. economy. Historically, a reading around 100% was considered fair value. Below 80 to 90% was a buying opportunity. Right now, depending on the methodology, the indicator sits somewhere between 176% and over 227%. For context, at the absolute peak of the dot-com bubble in 2000, the indicator reached only around 140 to 160%. On certain measures, this market is priced more aggressively than the most famous bubble in modern history. But, and this is important, Buffett himself has warned against relying on any single metric, even one with his name on it. If this breakdown is helping you think more clearly about your portfolio, drop a like on this video. It genuinely helps more people find this analysis. Now here's where the story takes a turn nobody expected. The Abel twist. On December 31st, 2025, Warren Buffett officially stepped down as CEO of Berkshire Hathaway. The following day, his long-designated successor, Greg Abel, took the wheel. And at that May 2026 annual meeting, the symbolism was impossible to ignore. Buffett sat in the audience as chairman, while Abel ran the show from the stage. And while everyone was reading Buffett's cash mountain as a giant warning sign, Abel looked at the very same market and started spending billions of dollars into the exact opportunities Buffett had spent years avoiding. Take Alphabet, the parent company of Google. Berkshire had dipped a toe in with a roughly $4.3 billion position in late 2025. Under Abel, that stake was more than tripled in a single quarter, ballooning to around $17 billion and making Alphabet a top 5 holding. Then, in June 2026, came the move that really turned heads. Berkshire committed another $10 billion to Alphabet directly, as an anchor investor in the company's enormous AI infrastructure fundraise. And here's the detail that matters. That $10 billion went in at a negotiated discount, on terms never fully disclosed to the public. This was Berkshire's first serious move into AI, structured almost exactly like Buffett's legendary 2008 crisis deals, where he handed over capital in exchange for terms nobody else could get. Except this wasn't a crisis, and it wasn't Buffett. Abel also re-entered the airline industry, taking a $2.65 billion stake in Delta Airlines. Now remember the history here. Buffett famously dumped every airline stock in 2020, calling the sector a bottomless pit. Reports suggest Buffett wasn't even consulted on the Delta decision. Then there's housing. In late May, Berkshire agreed to buy home builder Taylor Morrison for $6.8 billion in cash, paying a 24% premium to do it. Abel's plan is a far more hands-on interventionist style than Buffett ever favored, and yet Buffett gave his blessing. He said of Abel's homebuilder deal, and I'm summarizing his words, that Abel moved faster, smoother, without even making a phone call to the CEO that Buffett himself would have needed to make. What this means for your money. So here is the contradiction sitting at the heart of the most famous investment company in the world. The same firm that spent 14 quarters building the largest cash hoard in American business history is now deploying billions into AI, airlines, and housing. Two completely rational men looking at the same data, reaching opposite conclusions. And here is the uncomfortable truth. We cannot copy either of these trades. When Abel put $10 billion into Alphabet, he got a negotiated discount that arrived via a private weekend phone call, a call none of us will ever be on. If you or I tried to follow that exact move, we'd pay the full market price, on the worst possible terms, every single time. And there's a deeper trap hiding inside your retirement account right now. If you own a simple S&P 500 index fund, the thing most pensions are built on, you think you own a broad, safe basket of 500 companies. But Berkshire's own portfolio is now roughly 70% concentrated in just 7 stocks. And the broader market is in a similar place, with a handful of giant names driving almost everything. Your diversified fund is in reality a concentrated bet on exactly the kind of expensive market Buffett refuses to touch. There's one more layer to this. The 13F filing is published 45 days after the quarter ends. By the time you've read about what Buffett or Abel did, the moment has already passed. When the Delta position was revealed, the stock jumped over 3% in after-hours trading almost instantly. The information reaches you last. So what is the actual lesson here? It is not to copy Buffett. It is not to copy Abel. The real lesson is to study their discipline. Buffett is earning $15 to $20 billion a year doing nothing because he built the patience to wait for real value. Abel is deploying capital boldly because he built the analytical framework to recognize opportunity when it arrives. Both of those things, patience and framework, are things you can build. The people with the most money and the best information are positioning for one of two things: safety or asymmetric opportunity. The question is, which one fits your situation right now? Drop a comment below. Are you with Buffett on this one? Or do you think Abel has read the market right? I read every single comment. And if you found real value in this breakdown, share it with one person who needs to hear it. That is genuinely the best way to support what we do here. I'm Alex Carter, and I'll see you in the next one.